1 month ago, February 11th, 2026, something shifted. It was not the first time the market fell. It was not the first time you saw red on your portfolio, but this time felt different. And in the 30 days since, 25 lakh crore have been wiped off from the market. Millions of retail investors have made decisions they may regret. And the question everyone is asking is the same. What do I do now? So today, we are going to do what DeKoder does best. We are not going to tell you to panic. We are going to decode what actually happened in these 30 days, what retail investors across India are getting wrong right now, and what the data actually tells you to do. So let's begin. To understand where we are, you need to understand the three forces that hit the Indian market simultaneously. Not one, not two, three. AI disruption that happened in Jan 2026. So when DeepSeek AI launched, it rattled the global IT stocks. India's Nifty IT index wiped out close to about $68.6 billion in market cap. This matters because India's entire IT sector represents 15% of the Nifty 50 weight. Shock 2 is the Trump tariffs that has been a cause of concern. But in Feb 2026, the US launched a tariff offensive on global trading partners. Foreign institutional investors, the FIIs who had been buying Indian stocks, pulled out of India. The equity inflows dropped 14% month on month in January 2026 alone. And the shock 3 was the US-Iran war. The US military action in West Asia impacted the Brent crude that has now surged above $100 per barrel. The Strait of Hormuz, through which 85 to 90% of India's LPG imports flow through, was now in tension. The Nifty fell 5% in the week after the war began. Each of these shocks alone would have been manageable, but together they created what the strategists are calling a toxic cocktail, a phrase used by Economic Times not so long ago. But here is what most people are missing. The context. And this is the context that most people ignore. The average return of Nifty 50 in the last 25 years has been 13 to 14%. The average return of Nifty 500 in the last 25 years has been around 15 to 16%. This 25-year period includes the 2008 financial crisis where Sensex fell 60%, 2020 COVID crash where Sensex fell 38%, the 2022 Russia-Ukraine war, multiple FII sell-offs, multiple oil shocks. In every single case, markets recovered and went higher. The market has seen this before. The question is not whether it recovers, but the real question is what are you doing while you wait? And that is where the data gets uncomfortable. We conducted a comprehensive analysis across digital platforms over the past week, analyzing discussions, tracking sentiments, and even examining some investor conversations across financial communities. This revealed patterns that are both predictable but deeply concerning. So what were the top 5 retail investor concerns? Concern 1, should I stop my SIPs? Concern 2, my portfolio is down 15 to 20%, should I exit? Concern 3, is this the beginning of a bigger crash? Concern 4, should I move everything to gold or FD? And 5, the stock market is lava thanks to global uncertainty. Let's take each one of these seriously. These are the questions of people who have worked very hard for their money, and watching it shrink cannot be easy. So, should I stop my SIPs? The answer to that question lies in data. In February 2026, the SIP flows was around 26,000 crores alone. So month on month, it fell by around 4%. What was the reason? SIP cancellations were rising. And what did the experts warn? That market corrections spark SIP cancellations. Investors may be making a costly mistake. When the SIP flows dropped by 3.7% in February, that means thousands of investors paused or cancelled their SIPs at exactly the wrong moment. Here is the brutal irony of that decision. When markets fall, your SIP buys more units at cheaper prices. That is the entire point of rupee cost averaging. Stopping your SIP during a crash is like refusing to buy your favorite brand because they are on sale. So what is the rupee cost averaging and how does it work? Assume that in month 1, the NAV, which is the net asset value of your mutual fund, is 100 rupees. You invested 5,000, so you got 50 units. In month 2, the NAV fell to 80 rupees. That 5,000 now got you 62.5 units. Month 3, when your NAV went up slightly, your 5,000 rupee got you 55.5 units. Month 4, the NAV was 110. So your 5,000 rupee SIP got you 45.5 units. Investors who stopped in month 2 missed the 62.5 units at 80 rupees. Investors who continued have 11,000 more in their portfolio, even though the stopped investor has a higher percentage return from 17.5 to 23.75%. And why is that? Because the continued investor invested more total capital and got more units at the crash price. The concern number 2 is my portfolio is down 15 to 20%. Should I exit? This is the most dangerous question because the answer depends entirely on why you invested in the first place. The retail investor trap. In our recent interview, Nilesh Shah, Managing Director of Kotak Asset Management Company, said, in times of crisis, follow the dharma of asset allocation. So, asset allocation being the key. This was one of the many incredible things he said. If you missed that interview, the link to it is in the description below. So, let's talk about numbers because that's what matters the most, not the scary headlines. The actual data, say from February 11th, from the peak of the market, tells us that it fell by about 10%. From September 2024 peak, the markets fell by around 15%. The 1 month performance means that there's been a consistent decline amid serious geopolitical tensions. So what 25 lakh crore actually means? BSE market cap wiped out 25 lakh crore in early March 2026. India's GDP for the year 25-26 is estimated around 330 lakh crore. So what did the market cap actually wipe out? It wiped out around 7.5% of India's annual GDP. Just for some context, in 2008, when the market fell by almost 60% over 12 months, during COVID crash, the Sensex fell around 38% in 40 days. And in the current correction, the market has fallen around 10% in 1 month. So this is a correction, a reaction, but not a collapse. Now let us talk about the rupee because this is the concern that is quietly hurting us and getting the least amount of attention from people. The Indian rupee has fallen to an all-time low of around 91 rupees against the US dollar in March 2026. This is a new historic low, marking a significant depreciation of the currency. What this means for you? Well, when the rupee weakens, imported goods become more expensive. Electronics, fuel, medicines, and many other things. Foreign education becomes more expensive. Travel abroad becomes more expensive. India's overall import bill will rise, which creates pressure on inflation across the economy. And then there is the IT sector. This is the story that most retail investors have not yet fully understood. The AI disruption that's going to impact India's IT sector. The real fear is that if AI automates coding, testing and all the support work along with it, India's $250 billion IT export industry faces structural disruption. The reality check is that yes, India's top firms will face this structural disruption, but they are also pivoting to AI services. TCS, Infosys, Wipro are all investing heavily in AI capabilities. So there will be short-term pain, but a long-term pivot is underway. So let's address your concerns one at a time. Is this a buying opportunity, or are you attempting to catch hold of a falling knife? The expert consensus is that, according to even Mr. Nilesh Shah, is follow the principles of asset allocation and align it to your time horizons. The concern too is, should I shift everything to gold? Well, gold serves as a useful diversification tool, cushioning portfolios during inflation, currency volatility, and global uncertainties. A modest allocation enhances stability, but it should complement, not replace, long-term growth-oriented assets. Your concern 3 is, what about FDs and debt? Well, current fixed deposit rates in March 2026 is around 7 to 7.5% of major banks. If you discount the inflation, which is around 5 to 6%, the real return that you're getting is around 1.5 to 2%. So fixed deposits are not wealth creators, but they're great capital preservers. Is my small cap or mid cap fund totally destroyed? So the fact is that the small cap index did fall from a 52-week high down by around 15%. And the mid cap index did fall from a 52-week high by about 12%. But let's look at the historical precedent. After 2020 COVID crash, small caps recovered 100% plus in 18 months. After the 2018 correction, small caps took 3 years to recover. The key variable is the time horizon you need to ask that you have. If your time horizon is 7 to 10 years or 1 to 2 years, then that changes the dynamic completely. So what does the data say that you should do? After all of this and after all the data, what does the evidence actually tell you? We can't give you advice, but we have a framework, and it's called the 3-question framework for every retail investor. Ask yourself these questions. Question 1, when do I need this money? Is it less than 2 years? Then maybe moving to a debt or a FD is right for you. Equity is not for you right now. If it's 2 to 5 years, then maybe you should stay invested. If it's 5 years plus, then this correction might just be a gift for you. Continue your SIPs, consider adding. Question number 2, is my portfolio diversified? Are you 100% invested in equity? And if you are, then are you 100% invested in small cap? Or are you diversified already? The answer is the writing on the wall. You know what you should do. The third question you should ask yourself, am I reacting to news or following my financial plan? If you're reacting to news, stop. Call your financial advisor and follow a plan and stick to it. Trust the process. And here is the most important thing that I want to leave you with. The recovery precedent. In 2008, during the global financial crisis, when Sensex fell 60%, the recovery time was 18 months to previous peak. The 5-year return from that crash was around 200% upwards. In 2020, during the COVID crash, when the Sensex fell around 40% in 40 days, the recovery time was around 6 months from the peak. The 2-year return from that crash bottom was 120%. From the current correction, which is February to March 2026, Nifty has fallen by around 10%. This is not a 2008 or a 2020 level event. India's domestic SIP flows, which is the new stabilizing force, is there for you. And what I mean by that is that India's retail investor base is now 10 crore strong. The SIP contributions, even with a 3.7% dip in February, remain at nearly 26,000 crore per month. That is a wall of domestic money that did not exist in 2008 or 2020. 1 month ago, on February 11th, a lot of people got scared. Some of them stopped their SIPs, some of them sold at a loss, some of them moved everything to gold. And some of them, the ones who had a plan, did nothing. They did nothing because they understood something fundamental, that the market does not care about your fear. It does not care about your anxiety. It does not care about WhatsApp forwards your uncle has sent you about the crash. The market rewards one thing and one thing only: discipline. This is DeKoder, and we are here to decode finance so you can make better decisions on a daily basis. If this video helped you think more clearly about your money, share it with someone who needs to hear it today. And if you have questions, drop them in the comments below. We read every single one. I'll see you in the next one.